So welcome to Miami. I'm at the penthouse, the Triple X. It's called Unique. There's only one. It's for sale at $59 million. How lucky are we to be here today? We're going to be doing an interview with Colin from Milo, all about how foreign nationals and the wealthy individuals can buy property in Miami. Fantastic. Just look at that view. This is the tallest building from New York to Miami. 70 floors with a helipad at the top. Amazing views of Miami Beach. Fisher Island down below, which is the most exclusive real estate possibly in the world. So welcome to the channel. I'm so pleased and delighted to welcome Colin from Milo. We're going to be talking about how foreign nationals and nationals can buy luxury real estate in Miami. Yeah. Colin, welcome.
Thank you for having me, Paul. Really excited to be here and maybe explain how someone internationally could buy something like this.
Well, let's look at some numbers. So let's say we're going to buy a luxury apartment. It's $5 million. What is the deposit? What's the mechanics of how it works?
Yeah, so if we're talking just off of a loan side, you know, typically I say a roughly 30% down payment is the minimum. There are some examples where maybe you could do 25, maybe 35, depending on the program. But in general, I would plan on a 30% down payment to get the loan done.
So that's 70-30, 70% is the mortgage, 30% is the deposit. Now, is that the same for a foreign national? Let's say I'm visiting from London, I decide to buy. Does that apply to me, 70-30?
Correct, yeah, that would be for a foreign national. You know, condos often require a little bit more equity than like a single family. So in some cases, a condo, you could have to put 35% down, where if you were purchasing a single family, you know, maybe it's 30%. Same thing applies, you know, same if you had a refi and you want to cash out, you know, usually the leverage is a little bit less on a condo, so typically 5 to 10% less.
So for us in England, what is a condo? Because we wouldn't have that terminology, we'd have an apartment.
Yeah, I think it'd basically be an apartment, you know, I know also could be called a flat in England, but in general, you know, any high-rise building with a homeowners association, you know, several people live in the building, and you know, typically with a condo, there's no land ownership, so you just own the unit in the building.
Fantastic. And what are the sort of terms that you can get? How does it work in America? Because you have arms and we have legs, but no, joking aside, there's different terminology. How does that work?
Yeah, I mean, we have arms as well. We also have a 30-year fixed, which I believe is a little bit more common here than it is in London. You know, I would say over the past several years, the 30 fixed has been the most common type of loan that we've done for both US people and foreign nationals. You know, so typically 30-year amortization, rates fixed for the whole 30 years. As the interest rate market has changed, you know, recently, the ARMs are becoming much more relevant, and we're seeing a lot more of them.
What is an ARM?
An ARM is an adjustable rate mortgage. So
that's a variable rate. In our terminology, an ARM, an adjustable rate mortgage, is a variable rate.
Exactly.
And you can have a 30-year term.
Yep, so typically, I would say most mortgages in the United States are a 30-year term. In some cases, you'll do a 15, 20, but you know, the percentage is definitely very high on the 30-year mortgage. Just to get the longer amortization, you know, you're gonna have the lower monthly payment. But an ARM is typically fixed, either for like 3, 5, or 7. Those are the most common ARMs. There's also a 10-year ARM, but it just means that the rate would be locked for the first 3 years on a 3-year ARM, 5 years on a 5-year ARM. And then once you get to that, you know, on a 5-year ARM, that 6th year, it's going to adjust to, you know, some index plus a margin. You know, I would say the most common is SOFR, plus whatever margin is put in there to the bank, it'll adjust to that type of rate. There's also usually some type of cap. So the first year adjustment can't be higher than 2%, and the life of the loan, the adjustment can't be higher than 5%. So those would be the most probably common terms on an ARM.
Fantastic. And what sort of arrangement fees would you normally see with arranging a mortgage or finance in America? Yeah,
so on a foreign national loan, I would say the average is probably roughly 2% of like an origination fee.
Yeah.
You know, it could be 1.5%, 2.5%. There are some examples with maybe some shorter term loans, which we can get into, you know, like a bridge loan or like a hard money loan, which could be maybe a little higher, 2-3%, you know, would probably be where you're at.
And why would we have a hard money loan?
Yeah, it's more for someone that needs a quick solution or a short-term solution. So most hard money loans are either 1 or 2 years. You know, maybe you could find a 3-year one, but you know, typically we see a 1 or 2 year. You know, at Milo we have a 1 or 2 year option. The biggest advantage that you can close very quick. So you know, a lot of times you can close in 2 weeks, sometimes less if everything's there, and you also have no prepayment penalty. So some foreign national loans do have a prepayment penalty of either 1 year, 2 year, 3 year, where there's a fee if you pay it off early. The short-term loan or the bridge loan is going to have no prepayment penalty. So the goal is really to get you to another solution. So that's why it's called a bridge. You know, it's a bridge to an additional alternative. You know, maybe it's to pay the loan off in a year, maybe it's to refinance in a year. You know, it's just kind of a short-term solution to get the money needed to either purchase or on a cash out, you know, basis. And then the customer will usually figure it out, you know, in a year or so, what their next solution is on that property.
So what's normal in America then? What is the process? So I find a property, I make an offer, and then the finance, what other fees are there? So we've got arrangement fees with the bank. What other fees and terminology would I need to understand? Yep,
definitely. So you're gonna have title fees, certainly. So it's just also, you know, an attorney fee. So it's basically whoever's doing the closing, you know, looking up the survey, making sure there's no liens against the land, you know, etc. So that's usually the title company. And in some states, it differs by state who does it. Either a title company or an attorney will do it. Then you're also going to have like taxes and insurance. So we call it escrows. It basically means prepaying for your property insurance. You know, if you have flood insurance here in Miami, you know, some properties certainly have flood insurance. Some properties here in Miami have wind insurance for hurricanes. So it just depends on the property, but it's paying those up front. And then in most cases for foreign national loans, the taxes and insurance are collected within the monthly payment. So, you know, you can either pay them annually, right? You can pay your tax bill once a year, your insurance once a year, but a lot of foreign nationals, and you know, that's just what we call anyone from a different country that is purchasing here, they like to have it in the payment. Just because they're not here, you know, just let the mortgage company handle it. So we'll collect 1/12 of that tax bill, 1/12 of that insurance bill in your monthly payment, so that when the bill is due at the end of the year, you know, we don't come to you and say, hey, you know, you owe $30,000 for your tax bill or whatever the tax bill is. We just pay it because we've already collected 1/12 of it for you. But setting that up, we usually collect 2 to 3 months in advance just to kind of fund that account, because, you know, a lot of times insurance can increase or your tax bill can change, and we never want to be short in that account. So there's usually a little bit of a buffer of like 2 or 3 months that are collected up front at closing just to fund that account and make sure we have enough in there. And that's, you know, that's usually the combination. So it's escrows, title, and then lender fees will usually be the combination of fees you see at a closing.
Fantastic. And what about valuation fees? Does the bank get a valuation on the property?
Definitely. So we're always going to order an appraisal. That's usually included in the lender fees. You know, it depends on the price of the property, but it could be anywhere from, you know, $500, $600. If you're purchasing, you know, a huge property, the price will be higher. You know, it could get up to like $2,000, $3,000, $4,000. You know, maybe if you're purchasing the penthouse here for what, 50, 60 million, you know, it could be a little bit more expensive.
$59 million.
Yeah. So, you know, obviously the fees will be tagged to the price of the property, but, you know, in general, an appraisal will be ordered by the bank up front, just so we can get the valuation of the property, because that's a big aspect of getting the loan done, is knowing what the value is. In the end, most banks, and I would say probably almost all, will only lend off of the appraised value. So if you purchase a property for $2 million, and you want to put 30% down on that $2 million, if the appraisal comes back at 1.8, we would only lend off of 1.8. So you would either have to bring the additional, you know, 200.
That's really important. So you're only going to lend on the valuation of the property, not the actual purchase price.
Exactly.
That's an important consideration to remember, because obviously if there's lots of, like during COVID times, there were a lot of people bidding and frantically buying homes here, sometimes the prices were kind of overbidding a little bit.
Definitely. You know, and I mean, that's one of the biggest reasons the bank wants the appraisal, right? We're putting our money out on the property. We don't want to just trust the buyer and seller that they have the value. You know, we want a third party opinion to make sure that that value makes sense with what's going on in the market.
Fantastic. Is there anything else I need to think about? So I've just flown in from London. I'm going to buy one of these lovely apartments. You're going to do the financing, 30% down.
Yeah.
I've got my fees, insurances, wind insurance, flood insurance, valuation fee, which is the appraisal, conveyancing fee, which is the lawyer.
Yeah.
Anything else? Am I done?
So, I mean, we could talk a little bit about qualification, you know, and how people qualify for these loans, because there are several different options to qualify as an international person.
So how do I qualify for an international mortgage when buying in Miami?
So there's several different ways to do it. We kind of try to put it in 3 different buckets. So I would say the first bucket would be a full doc bucket. It means full documentation. We're looking at your income from whatever country you're from, you know, looking at all your bank statements, and typically these full doc loans, they will provide the best interest rates and often the best terms because we're doing the most underwriting. You know, these loans though typically take a little bit longer because there is an additional underwrite. You know, you really do look at that individual client's financial picture as thoroughly as possible to make a good decision on them. You know, with people being from all different countries, we get all different types of income documentation that we need to, you know, we need to translate it, make sure it makes sense to us. So that whole process can typically take 45, 60 days. You know, that would be on average. It can definitely be done quicker, but you know, that's kind of the expectation that I set with my clients, because I hate to say, hey, we could do this in 30 days, but you know, if something complicated comes up, you know, it does take that extra time to get it done. You know, with that full doc, another option is also asset depletion.
How does that work? What's asset depletion?
Yeah, so it's another way to qualify for the full doc type of loan. You know, instead of looking at, hey, this is how much money I make, you know, in England and getting those statements, if we see your bank account and you have sufficient assets in there, you know, we're talking more assets than the property is worth, probably by 2 to 3 times. You know, it depends on each situation. Then we won't even need to look into your personal income. We'll say, hey, look, the client has this much assets. Even if we take this over, you know, 12 years, 10 years, whatever we decide, they'll be able to make mortgage payments with those assets. So we don't need to look into their exact, you know, annual income because we see that the assets are there.
Oh, fantastic. So there you go. Always good to ask the question and get a great answer.
Yeah.
So that's 2 options. You mentioned there was a third. So you've got full documentation, you've got asset depletion. What's the third option available to me?
Yeah, it's what we consider a cash flow loan. In the US, you'll often hear the term DSCR, which stands for
DSCR.
So DSCR stands for debt service coverage ratio. It's also known as a cash flow loan. So rather than looking at the client's individual income, so, you know, what do you make annually, and kind of digging into that, what we'll do is we'll look at the property from an investment basis, and we'll compare what the projected rental income is, or current rental income if it's a refinance, to what the mortgage payment is. And that ratio lets us underwrite the loan, and it, you know, decides the terms. You know, it helps, the better the DSCR ratio, the better the rate. So it's a quicker way to get the loan done because we don't need to look into all of your personal financials. We still need to look at assets, but just on an income basis, we can use the property that you're purchasing to qualify.
Fantastic. Now, what is the rate differential between the 3 options? So full docs, asset depletion, and a cash flow loan. So what's the interest rate margin differential between all 3, from cheap to expensive?
Yeah, so the cheapest, the full doc and the asset depletion are typically kind of tied together, because since you have these assets, we're able to still do the, you know, quote unquote full doc loan without looking at your income. So those are pretty much the same. The next one would be that DSCR loan, and it's probably 1% to 1.5% higher, depending on how that, you know, that cash flow ratio comes in. So, you know, you probably pay 1 to 1.5% more.
I'm in Miami, and a full documentation loan is about 1 to 1.5% cheaper. That's the best option to find.
Definitely. If you have the time and you're well qualified financially, that's going to be the best rate that you can get.
So I understand that I could get a bridge loan. What does that mean, and what is that going to cost me?
Yeah, so a bridge loan is basically the quickest, and if you have the assets, the easiest way to qualify. So, you know, we're not looking into the person's, you know, financial income. We're really just looking at the assets. Typically you need about 40% down, so a 60 LTV, but we can close very quickly, you know, usually 2 weeks, could be less. And the rates are a little bit higher because of the lack of underwrite, right? So less underwriting, higher rate. rates on these are, right now typically anywhere from 11, 12, 13%. And big advantage is that there's no prepayment penalty. So usually you see people get these for like 1 year, 2 years. They need money now because they have an investment that they need to do in 30 days. So they want to do a bridge loan on a property they own, or they were getting a mortgage. It's not going to work out. They have the assets. Let's just do a bridge loan.
So in uncertain times, you might want to get a bridge loan to act quickly, get a deal done super fast within 2 weeks. So if there's someone in a little bit of trouble, you want to buy fast, move fast, a bridge loan could be the solution for you. Once you've got the bridge loan solution, you can then look and plan for the longer term. And what is the interest rate differential between a bridge loan and a normal full doc loan? What's the difference between that speed?
Probably roughly 4%.
Wow, so 4%. So bridge loan to full docs, you're going to save 4%. But if you need to buy and move quickly, you may be buying at a 10 or 20% discount, and you're going to get the deal done quick, 2 weeks, then refinance later. It's 4% saving.
Exactly.
Fantastic.
Exactly.
So guys, there's 7 penthouses, $22 million each. There's only 2 left, and the XXX called unique. There's only one in the whole of the world, Aston Martin Residence, right here in Miami. $59 million is the special price just for you. What about that, Colin?
Sounds good. If you need a loan on it, just let me know. We're here.
Hey guys, links and comments below. If you want to get in contact with Colin, please do. Fabulous to be here. Amazing, amazing weather, amazing people, amazing food. Don't we just love Miami?
Of course, I never left. I've been here for 10 years.
And I'm just visiting. How about that? Second time. Fantastic. Colin, thank you very much.
Thank you, Paul.
Cheers. Thank you.